So agenda for the session. So I think we'll initially just cover off kind of who Capsule are, why we exist, how we can kind of start kind of serve the community a lot better, risk management and how that kind of translates to your insurance premiums, benchmarking and kind of what appropriate levels of cover you should have or think about at different stages of your business life cycle. An interesting topic around ESG and insurance and kind of how you should be factoring that into the insurance process, and certainly kind of a conversation that you should be having with your broker. And then a little bit of a cheeky one of just how to get the most out of your insurance program, how to get the most out of your broker, and some kind of tips and tricks, I guess, of kind of how we would approach that with either your current broker or even with Capsule if you use us as your broker. So introduction to Capsule. So we are an insurance provider exclusively for high growth and venture backed businesses. So that's exclusively all that we serve. I guess from that's, as Osreen said, right from kind of seed to IPO stage. So we have a really kind of unique picture, I guess, of how the risk profile of a business changes as they go through the kind of various series funding rounds. And the reason why I started Capsule, co-founded Capsule, is we exist in a world where brokers are often very traditional, very transactional, kind of unbelievably there's kind of still kind of brokers and kind of certain processes in insurance where things have to be paper based, and so we are a firm believer in making sure that kind of we're, I guess, being the innovators in the sector to use technology and data to be a more proactive partner to get the best possible terms from insurers and continually drive that evolution so that insurance keeps pace with the growth of your business. I think that's all too common. The kind of the most common scenario that we come across is that when we look at insurance on an annual basis, certainly in this sector it's particularly exaggerated, is that by the time that you get to renewal, or well before you get to renewal really, your insurance program is out of date. So if we think of that common scenario where a business raises capital, kind of often that capital is then going to be used to accelerate the growth within the business. So scaling headcount, launching internationally, launching new products, kind of doing lots of cool stuff as you should be doing. Actually, quite often insurance is the thing that's left behind or left forgotten about of kind of making sure that you're updating your insurance program as you do the kind of the things that you are focusing on within your business. So with the use of technology, so as an example, that Capsule track all fast growth businesses in the UK and about 300 or 400 different data points. We use that tracking data, or we use some connectivity technology. So we have a capture portal, which is we can connect your financial accounting software. So we use existing technology, often in insurance for the first time, but as a means of making sure that we're kind of far more connected and transparent as a partner to be that kind of strategic growth partner as you scale. As Osreen said, we kind of support many of the operations station community members at the minute. So likes of Onfido, Jubal, Kodat, Otter, and I'm obviously presenting today as Capsule co-founder. We also have Sham on the session today as well, who is the manager for the relationship. So if there's any questions or anything, then you can direct that towards Sham as well. So as a mean of a bit of scene setting, I guess, for a market update. So quite often you might hear some of these phrases being kind of suggested by your current broker at the minute, and I want to just explain what those mean in reality. So we have gone through what they call a hard market, by that we mean kind of in non-insurance terms. Ultimately, lots of claims, lots of kind of even kind of macroeconomic things of natural disasters, wars, etc., that mean that insurance companies are performing badly. They're paying out lots of claims, not getting as much premium. So the insurance market tends to be on a kind of fairly cyclical kind of cycle of going through what they call hard and soft markets. And at the minute, if you're in a hard market, that means that there's a reduction in the amount of capacity that insurers are happy and comfortable to put down. Statistically, what that involves then is an erosion of product quality, an increase in kind of excesses, an increase in premiums. So not to be the kind of doomsday, but it does mean that kind of typically that's not a good thing for clients. You're going to be paying more in premium and you get less in return. So what's that meant in reality? It actually means that kind of most of the clients that we begin talking with have insufficient policy programs. Either they're kind of paying too much premium, their excess is too big, they don't have the right amount of cover, and these are all kind of drivers coming from insurers' behaviour in a hard market. We've been going through that for a number of years, so we've probably been going through that for the last 3 or 4 years. It is starting to soften. So again, kind of what happens in that scenario is more insurers are kind of willing to offer quotations. They're starting to willing to offer kind of higher limits. You find reductions in premiums. It's not across all areas. So I'd say, especially with in particular cyber liability, very much remains in that kind of hard market area at the minute, where I imagine kind of most people on this call have kind of felt the pain of either not being able to arrange kind of reasonably priced cyber reliability insurance, or kind of not being able to access it at all. But it is giving us a real opportunity in that market, in a softening market, to make sure that all clients should be reviewing what policies they have in place currently, what premiums are they paying, what limits do they purchase. And so it's actually a great opportunity for us at the minute to make sure that we're kind of finding that benefit and that saving, most likely, for any clients that we have or prospective clients we speak to. In terms of the funding landscape, so obviously clearly everyone here, including Capsule, live in the kind of high growth VC world. I think kind of fair to say that kind of 2023 was a little bit of a struggle from a funding landscape perspective. So we have seen businesses far more concentrated on conserving runway and thinking about how kind of we can find material changes in insurance premiums. So again, it's one of those challenges that we would suggest any client have with their current broker, is to set an objective at the start of the program. So if you're going through a renewal cycle and actually fundamentally premium is the kind of be all and end all of your renewal process, then that's definitely something that you should be setting as an objective with your broker. What we have seen though is that I think kind of clearly there's encouraging factors as we come into 2024. So I think we're kind of venture market being higher than kind of the pre-COVID levels. I think we're kind of starting to see that trend buck, and it's looking promising for 2024. We're also still seeing, I guess, brokers not being equipped to service high growth companies. So where your business is scaling quickly and moving kind of a very quick rate, and kind of quite often could be pivoting into kind of new sectors or new products. Actually, in most scenarios, most brokers would see that as a kind of a pain to be able to have to service you as a business kind of more than any other traditional kind of SME business. I think again, what kind of this all points us towards is making sure that you have a specialist partner that kind of knows how to service high growth and kind of fast moving businesses. So we want to take a look at risk management and kind of I guess, give you a bit of an inside view of how we would start to approach kind of risk management, or start to look at how risk management in business and ultimately insurance exposure within a business relate to each other, and hopefully impart a bit of wisdom today on thinking how could you kind of start to assess that in your own business. So at a very, very basic level, there are three areas that we look to consider when we're assessing risk within a business. So any opportunity, any kind of client that comes to Capsule, we would almost do a kind of a clean slate view of, okay, how do we, what are the exposures within this business? So we typically look at three areas: assets, liabilities, people. So within assets, that's normally kind of offices, equipment, kind of whether it be manufacturing equipment or computer equipment. Digital assets is actually kind of obviously clearly a lot more prevalent within the technology space. So kind of your data ultimately, and how that is kind of quite often one of the biggest exposures for most of the Capsule clients. Liabilities. So again, whether there are legal liabilities, so for the fact that you start kind of employing staff, there's a legal liability to protect staff, whether that's contractual. So again, kind of as we see a scaling journey, the contractual obligations or contractual liabilities that a company has increases quite significantly. Certainly when looking to kind of take on larger enterprise clients or expanding to the US as an example, actually these things are kind of quite pivotal things within the kind of business life cycle. The other one, the liabilities, might be a regulatory liability. So Capsule operate in kind of the fintech sector as an example. So it's quite a clear exposure there of a regulatory exposure to the FCA as an example. Could be things like the ICO and things like that in there as well. And then with people, so again, that's could be staff. So the common one, employment of staff, could be how you're looking to protect or kind of how you're exposed to contractors. We even look down to what's kind of common within Capsule clients is the rise of EOR structures. So that's an employer of record structure for kind of how you engage with staff in overseas territories. Again, those things will all have an impact on how we look to assess risk within your business. And I think actually, if we take that typically to a technology business, that normally results in cyber liability and professional indemnity risk as kind of up there as almost number one exposure to that to the business. I put on there around the distributed global teams. I think we had a question actually that was submitted in advance of this, or a few questions actually, around how we think about global insurance. So just if I just dip into that for a second. So with a business expansion internationally, we tend to see quite a common journey of three stages of how that expansion happens. So we would look at initially the business takes revenue from an overseas territory. So if we think of a UK business, UK kind of domiciled company that is expanding to the US as an example, very kind of well-trodden path this. So start to engage with customers in the US, start to generate US-based revenue into your UK business. Each of these stages, by the way, do have an impact on your insurance program. So it's kind of good to know how this impacts each stage. So when you start to take revenue from let's say a US client, actually we need to make sure that your professional indemnity, your cyber liability, a few other insurances are based on a worldwide basis. So quite often people would say, well, yes, I've got professional indemnity, so that covers kind of any contractual requirements I have, or kind of any risk of any claims from customers. Actually, if that's only on a UK only basis, or it could be worldwide, excluding the USA and Canada, that's going to be kind of affected if you're then having a claim from a US customer. So first step, number one, is generating revenue from that territory. The second, normally behind that, is opening a subsidiary in that country. So again, if you're starting to have overseas subsidiaries or any subsidiary underneath your business, you want to make sure that, one, that subsidiary and any, let's say, any directors or any activity that's carried out within that subsidiary is covered. So we tend to say the best approach to doing some of this is making sure that you cover insurance at the highest point in your corporate structure. So if you have a UK topco and a US subsidiary, you take out as much insurance as you possibly can in your UK topco. So you insure as much as possible at a group level. So those insurances that you would normally include in that would be professional indemnity, cyber liability, directors and officers liability, public and products liability. So anything that you can put at a group level, which cascades cover worldwide and to all subsidiaries within your group, is by far the easiest, most cost efficient, most kind of time efficient way of looking to arrange your cover. You then only really want to take out local policies where it is absolutely necessary. So the normal, the common policy that you would need to take out is where you start to employ staff directly in an overseas country. So in the example of opening a US subsidiary, at that point where you don't employ anybody, actually we can cover everything from the UK. When you look to get staff or assets within that territory, so if you're employing people directly into that territory, there's a requirement, there would normally be a requirement for you to hold what's known as workers' compensation locally. So you'll normally either do that, which is the UK equivalent of employer's liability, or you would do a contribution to a kind of a state-run scheme. So places like Spain and Portugal and Germany have kind of state contributions. So actually on that kind of journey of overseas expansion and kind of ultimately getting to that goal of a kind of a globally distributed team, actually there are kind of quite significant stages within that expansion where we can identify that the insurance kind of requirements or the risk profile in the business changes. So again, kind of appreciate I've just kind of thrown a lot of information there, but if there's anything that you'd like us to kind of give more guidance on, or if kind of you want me to lay out those steps in a bit of a clearer way, perhaps, then we're happy to do that after the session. Hopefully that's kind of answered the kind of some of the questions that we had on globally distributed teams, but again, we can kind of go into specifics if needed at another time. And what's our approach to risk management then? So I guess there's almost 3 stages to this. And the first one is being able to identify what exposures there are in your business. So whilst we look at kind of assets, liabilities, and people, and almost with an insurance lens, we tend to look at it in those 3 categories, and that gives us a good view of what the insurance requirements are within the business. Actually, the almost risk management is far more encompassing for the business itself. So apologies if this is slightly too basic, but as a number one, understanding the risk within the business is an absolute must. So kind of actually we still get inquiries from businesses at the moment that don't have a risk register in place, as an example. So as your insurance partner, actually a risk register is quite often a really key tool for us to look at and understand almost in your own language what risks you think that you face as a business, and we can then look to identify how insurance translates that. So quite often, risk register, you'll look at regulatory risk, operational risk, competitor risk, even things like IP risk registers. So we're coming far more frequently now that kind of businesses will have a dedicated or separate IP risk register, cyber security or infosec, economic risks even. And so I think even kind of a very basic level, starting with a very, very big long list of what are the risks that are faced within this business. And I think there's two steps really then to follow after that, which is one is how does the business protect itself against those risks? So are there things that the business can put in place internally, maybe not to remove that risk, but certainly to reduce it. And from, again, with our insurance hat on, as much as you can do that in advance, and the business has taken steps to identify and mitigate as far as it possibly can itself, actually insurance is the final step in that process. So quite often we will take a client's risk register, take a look at that and review kind of, okay, let's get a good understanding of the business itself and its exposures, but we can almost overlay insurance as the safety net to all of these risks. So actually just by simple almost adding a separate column into what is normally just a spreadsheet that says, is this kind of insurable? Yes or no. Not everything is insurable, but most things we can find an insurance policy for. Does the business have cover for it currently? And if so, at what level? And actually that kind of completes that rounded picture of how do I identify, mitigate, protect in those kind of three stages, and insurance being the kind of final stage. I think for businesses where they've already done the identification and the mitigation as far as possible, those are the businesses which insurers want to see, insurers like to see, insurers will offer the best terms for, because ultimately they're the ones that are almost the kind of risk conscious clients that ultimately make a kind of a better risk profile for insurers. So again, if there's any interaction with your broker currently around kind of what insurances you need, what level of insurances you might need, what risks you have in the business, if they've not already, perhaps get them to take a look through that risk risk register and feed back to you about kind of how that translates to the insurance program that they've arranged for you. And I think where I pulled out two areas of exposure, but also kind of translating it to insurance for professional indemnity and cyber liability, that most of our conversations revolve around. So for any technology business, professional indemnity, which is cover for errors and omissions. So if there's anything wrong with the technology, if there's any failure in the technology that ultimately causes a financial loss to your customers, they can make a claim against you. Professional indemnity is what's going to cover that. Cyber liability is the protection of kind of ultimately any cyber event, any data breach, any hack or ransomware. So that's what's going to cover within that policy. Clearly, two big areas of exposure for any technology business. So how do we, again, accepting that this might be a too basic level for some of the people on this session, but it may well be useful as well. Actually, what are the things that are what are the things that insurers look at to make sure that they are for how they're going to rate any business, how they're going to offer a quote for any business. So with professional indemnity, it's all about contract management. So how are you contractually limiting the exposure that you have a business with any clients? So first of all, very basic level, make sure that you've got contracts in place with all customers and suppliers. I think that's where you're operating almost in trust, as they would say, is just never going to be a good position to be in come a claim event. Retain UK contracts as much as possible. Again, the kind of it's far more favourable to a UK insurer to operate on a UK jurisdiction in the event of a claim, rather than the other big one would be the US, and kind of where obviously clearly the US courts can operate in favour with things like punitive damages and things like that, far more in favour of clients. Cap liabilities in contractors as low as you possibly can, or negotiate as best as you possibly can. I think kind of where we see actually a benchmark of that of good there is the value of services that you're providing for the duration of the contract. Again, kind of had a kind of quite interesting scenario quite recently where there's kind of quite a lot of case law at the minute around how where there's interactions between B2B models. So if you're if you have a B2B SaaS model as an example, where there are liability caps within contract or liability clauses within contract, the courts will often side on the fact that essentially you're all grown-ups in the commercial negotiation, and that you should know exactly what you're getting into. So where there is a liability cap or kind of a limited liability clause in a contract, actually that stands up quite a lot of time. All contract being reviewed by legal professionals. Again, if you've got your own in-house legal team, great. If they use external legal counsel, definitely making insurers aware that that's a process that you've gone through, and making sure that you've highlighted that you've got tight controls there. For cyber liability in particular, kind of slightly said in jest, but don't waste your money on buying cyber liability unless you've got the right controls in the business. So quite often, certainly earlier stage businesses will come to Capsule and say, I need cyber liability. I need to protect, we need to protect ourselves. But actually, when you start to look at what are the controls that the business has in place currently, so it's their multi-factor authentication, is there cold and offline backups, have they done security taining, do they do patch updates? Some of these things, actually, if you're not meeting those minimum standards, an insurance policy isn't worth the paper it's written on. So there is definitely a piece of advice there to make sure that you have the right level of controls in place and you're meeting the expectations of the insurer ahead of putting any policy in place. So I would probably, again, if you have cyber liability, if you think that there's a doubt that you might not meet some of the terms and conditions within it, I would be pushing your insurance broker to make sure that they're clearly playing back to you what are the minimum requirements or what are the minimum things that you, or the key conditions within your policy that you need to meet to make sure that you're not falling foul in the event of any claim. Some of the bullet points there on that slide are, I guess, quite hygienic factors. I guess they're quite early stage factors. Clearly, as the business scales, we have companies that start in kind of our pre-revenue, hold no data, right up to kind of processing billions of data items every year. The level of interrogation in the controls that are in place and the things that we need to evidence to insurers differs wildly between those two scenarios. Again, where you have later stage businesses where there's kind of millions, tens of millions, hundreds of millions of data records, actually it's now a lot more into kind of what types of data, the locations of data, how it's segregated, how it's encrypted, transit and rest. Some of these things are kind of, there's lots of things that we can go into that, again, if lots of these things that sit outside a proposal form, that's what I'm kind of quite clear on, is if you are just simply submitting a proposal form with a load of tick boxes, yes, no, you're probably not doing your business justice on the things that you're doing within your business to control cyber liability in particular. So I definitely make sure that you're either having conversations with your broker and engagement with your broker, or even having a tripartite relationship with your broker and the insurer. So kind of meeting your insurer, sorry, and kind of being able to show some of the positive controls that you have in the business, I think is always going to be worth the time. And then this here is just, again, it's one of the. Oh, go on, Kip. Sorry.
Sorry, if you don't mind me jumping in just quickly. There was a question from was worth maybe touching on. So Osrim was asking around investors, and typically as part of the due diligence process, what insurance are they requesting as part of that process? It might be helpful just to give a bit of an overview of what we're hearing from a lot of the VCs that we're speaking to.
Yeah, it's good that we're on this slide actually. So we regularly talk with clients about being what we refer to as raise ready. So as just a kind of almost a spiritual approach when going into raising investment, is insurance is never going to be seen as a hugely positive thing, but it can very easily be seen as a negative. By that, what I mean is that if you don't have certain types of insurance, actually it's one of those things on a list of items which you almost want to just be, yes, tick, great, we've got the insurance in place, on you go. Focus on bigger things then. Is there insurance? Is the right insurance cover in place? So it's just a start for 10. Actually, it's a lot better for you to get your insurance cover reviewed in a good place, raise ready before going into those investor conversations, or at least before opening up your VDR. The more specific point around what insurance is, I would say, is actually the 3 insurances that you're seeing on screen now. So directors and officers liability is and key person insurance. Sorry, to add a fourth. Directors and officers liability and key person insurance is actually kind of the 2 insurances that we see on almost every single term sheet for any investment at any stage. So directors and officers liability is to cover the directors of the business in the event of company mismanagement. So the reason why, if we think with kind of put ourselves in the position of the investor, the reason why they would want to do that is it gives them greater confidence that in the event that there is misrepresentation during the investment process, or kind of one of the management of the business isn't carried out as it should do, actually it's kind of not going to be a business ending event. Actually, there's an insurance policy there that protects the directors and protects the investors. Key person insurance, again, it can often seen as kind of maybe seed, Series A, Series B, up to Series B probably, is cover for key individuals within the business for either critical illness or death. So quite often this is a kind of a policy that's taken out for, say, like the founding team as an example. So each of the individuals in that founding team, or the one individual, will take out a policy. That policy indemnifies the business if that individual cannot work either for an extended period of time due to illness, or in the unfortunate event of being killed or in death. So if that person weren't able to work for the business again, there's quite often there could be loss of revenue, there could be kind of a slowing in the business growth, there could be recruitment and kind of replacement hire costs, things like that that the business suffers. That so where an investor will require that policy to be in place if there's a reliance on a few individuals. Actually, again, it's just to protect the business and make sure that it can continue on in the event those individuals aren't there anymore. The second or the third and fourth insurance on that list would be cyber and professional indemnity. So touched on them a moment ago. Again, we're seeing this more and more now, certainly for technology businesses where investors are, I guess, being more forensic on the types of policies that you have in place, not just that you kind of have any insurance in place. So with them understanding that cyber and professional indemnity are kind of two big exposures within the business, then actually that's kind of the cover that they're expected to be in place. So always always D&O key person, sometimes includes cyber and professional indemnity. So hopefully that answers the question, Kit.
That's definitely helpful. And sorry, one other question whilst we're talking on the cyber point as well. So Kelly asking in the chat, our broker suggested connecting via VPN would be critical for any cyber. Should that be the case? What's your opinion on
that? Yes, albeit that we kind of see it as far less common now that there's kind of you would kind of be on a hosted or SaaS solution anyway. But yeah, I think that's a quite a common requirement that would come up. If that's not relevant, actually just going back and saying it isn't relevant and ignore that question, I think is perfectly fine. So just quickly touching on this slide then. So again, I know that kind of a few people are keen to know what limits are the right limits, or kind of what insurance is too much or too little. So what we've tried to do, admittedly, that question is hard, and it's hard for a number of reasons. One is there is a few different factors that come into play. So you've got we tend to look at a different lens depending on what insurance you're looking at. So for the D&O in this example here in that top table, we look at the number, the amount of money raised as an indicator for how exposed the business and the directors of the business are. So following that kind of common thought process of actually, if you've raised loads of money, you're going to have lots of investors, you're going to have lots of clients, you're going to be global in nature, et cetera, that means that actually the directors have more responsibility and therefore more exposure to a claim being meant against them personally. We split that out between non-regulated and regulated as well, because you have that regulatory exposure if you have to be regulated for whatever services you're providing. So we've tried to give a bit of a guide as to actually looking at the different businesses that we have as clients, actually what limits they buy or what limits we would recommend they buy at that different in that different phase. The one thing that I would always put here is that you have to overlay the fact that there might be particular contractual requirements that means that you have to step outside of this. So you might be required from a VC to hold a D&O limit at 5 million when you're raising £1 million of capital. So actually there always needs to be an element of real life added to some of this. Also, so on the professional indemnity and the cyber, again, we split between B2B and B2C, just as B2C is more likely to have claims and are more protected individuals than B2B. But we look at revenue here. So actually between 0 to £1 million of revenue, 1 to 5, 5 to 25. So actually, again, that's an indicator to us of more customers, more chance of a claim, kind of more risk, et cetera, et cetera. So again, try to give a typical journey of kind of how that should evolve as the business scales. This is probably more of an area where we would see the contractual requirements coming into play. So it takes a step. It quite often, done a B2B, you might suddenly get that one customer. Yes, absolutely, kind of could be business accelerating, kind of it will be a great thing for us to do, but they require us to hold 10 million pounds professional indemnity. In those cases, again, we're more than happy to review contracts, and your broker should be able to review any draft contracts and give their view on insurance, and also sit on your side of the table in that negotiation to say, we think it's reasonable, we don't think it's reasonable, here's a quote for 10 million, it's going to cost you £50,000. It kind of, you might want to go and build that into the cost of the contract. Those sorts of conversations that we can definitely, you should be getting into with your broker. So I'm going to quickly speed up because I'm conscious of time. So ESG and risk. So we've been fascinated since the minute we started Capsule. Really, we've been fascinated with how ESG, how the ESG profile within a business translates to risk. I think it probably stands to common sense that if a business has high ethics in relation to the environment, to the staff, to the community, to governance, then actually it means that they should be a better run business and a lower risk profile. So what we did about a year ago was do a joint study with Aviva, where we looked at all of the B Corps within the UK, so 588 B Corps within the UK at that time, and ask Aviva to do a look at the claims performance of that group of businesses versus their traditional SME book. And actually what that proved out was that businesses with a strong ESG profile, as all B Corps would do, are far more resilient. So they tend to claim less, claims are less severe, claims are less frequent, and therefore actually kind of in comparison to their peers, they present a better risk to insurers. So what that's meant is actually kind of one is Capsule's own ESG index. So again, it gives us another lever, another lens to work with you on to make sure that we're presenting your business in the best possible light and making sure that insurers are considering different factors when assessing risk within your business. We've also started to work with VCs and clients, prospects, to use the ESG assessment that you would have gone through any investment round to make sure that that's being factored in, rather than necessarily kind of saying, look, here's another kind of list of questions for you to complete. We can quite often take a VC's assessment of ESG and use that as part of your insurance renewal process. So what do we think? So moving on to the kind of tips and tricks, I guess. So what is best practice for if you were going to kind of take away some highlights? I think making sure that you have an independent review of your program at this time, as I mentioned at the start, is a great time to do that. Actually, somebody looking at whether the limits are correct, whether the policies are right, whether there's any key exclusions, looking to do cost benchmarks against peers. I think those kind of things it's free, or it should be free. So kind of definitely should be requesting that kind of either your broker or another broker does that piece of work for you. We haven't mentioned it during the session so far, but there is something in the insurance world called a letter of appointment, or a broker of record, as it's called in the US, which ultimately means that you're not tied to your insurance broker. You're tied to your insurance products. So if you have an insurance policy with Aviva, and you have your broker that arranged that for you, quite often you will have an annual insurance policy that you would need to stay into for the year within reason, but actually you can chop and change your insurance broker depending on who's going to give you the most value and the best service. So actually, if you're inclined to do so, changing your insurance broker midterm, so in between your renewal cycles can often drive a really good outcome. So it allow you to align some renewal dates. So kind of rather than having renewal dates spread all over the year, your new broker should then look to align it, look to consolidate insurers. It drives a better and more competitive renewal process. So again, there's lots of upside, and it's kind of not a very kind of, it's not a thing that your current broker will talk about. But there kind of is that ability to do things outside of a renewal cycle. And so if I were to leave you, and I'm wrapping up for the last few minutes, so if I were to leave you with 3 pieces of advice that you walk away from here today with, I think it would be these. So one is find the right partner. So make sure that you have the right insurance partner that is going to be additive to your growth and give you the best chance of success. Actually, once you find an insurance broker that understands your business, understands your journey, aligns with you ethically, even kind of has the best kind of technical knowledge, actually that should be the broker that should be fit to scale with you for the long term. We do sometimes see that actually clients kind of tend to try and put 2 or more brokers against each other, which really doesn't typically tend to kind of drive the best outcome for the client. Actually, it kind of normally means that there's a kind of a different communication, or different rhetoric and different presentations, etc., that's provided to the insurance market, which doesn't tend to drive the best result. Number 2 is be really upfront with the goals of your program. So kind of if you are going into a renewal period, or if you're having a midterm review with your broker, making sure that you're really clear on what are the things that you value the most. Is it the fact that you want to conserve runway, and so therefore it's cost efficiency? Is it the fact that you think actually our limits have lagged behind where our business is, so we need to increase the limits? Is it the fact that you're uncomfortable with certain exclusions being in the policy, that you need wider coverage? Some of these things will really matter when your broker is then therefore kind of trying to negotiate on your behalf with insurers. So actually being really clear with your current broker about kind of what you see as the objectives. And then number 3 is keep regular communication. So this is on part down to your broker, but equally making sure that you can keep in touch with your broker. At least, it depends on how much growth you have in the business. I mean, I have clients that I talk with weekly, but I'd say at least quarterly, actually just sitting down with your broker and going, this is what we've done in the last quarter, this is what we're looking to do next quarter, this is how we performed, these are some of the questions that we've got around kind of customer negotiations, things like that. There can be a kind of quite a common set pattern, but having that kind of working progress list with your broker will mean that there's not the step changes at renewal, there's no surprises at renewal, there's kind of things can be managed a lot better when you're closer to the broker throughout the year. So sorry, I know that I've rabbited on a little bit, but Kit or Sham, is there any questions that have come up in the chat, or if anyone wants to come off mute and ask any questions, I'm happy to share.
There aren't actually any more in the chat, but we did get a few prior to the session, and it kind of links in quite nicely to the slide that you've just gone over. It's a bit more capital specific, but the question is, I've seen health check referenced quite a few times. What's a health check? And if I book a free health check with Capsule, am I obliged to continue with you as a broker? And then just to tie it in with that question, do I have to wait until my renewal date to get the health check?
Okay. So a health check is ultimately us kind of doing a free review of your current insurance program. So how that works in practice, if you want to send us copies of your policy schedule, your policy wording, kind of anything that you've got in relation to your insurance, we're happy to digest all of that, kind of review it all against what we know against the business. So we kind of, before we track all companies in the UK, so we can kind of build quite a decent picture without really even speaking to you. But from there, we can play back your current program, summarize your current program, and play back any thoughts and findings kind of back to you in a kind of very concise way. So typically we tend to look at kind of cover, cost, capacity, conduct, and claims. So what cover do you have in place at the minute? Do we think that that's right with the level of the stage of business and kind of activities that you provide. Cost, benchmarking against peers, which we can do for you. Capacity, is it the right insurer? Is it the kind of, are they the most kind of appropriate insurers for your scaling journey? Conduct, so again, that could come through the risk register, review if you wanted us to, and then claims as to whether there's been any claims or whether we think that there's kind of exposure to claims there. So it's as kind of, as I said, it's a free thing. It's probably a kind of good time to do it. We typically kind of, if you sent it to us all today, we could have something, bearing in mind, unless there's any particular kind of real time constraint, we can do it within a week and present that back to you in a week's time. And it can be done at any point throughout your renewal. So you don't need to wait until renewal. I'd actually probably say don't wait until renewal. It's better to do it outside of renewal cycle where there's a little less pressure and you can absorb some information and no one's running to kind of have to go really, really quickly. But yeah, hopefully, Sham, does that answer your question?
Yeah, I believe so. And there are a couple more questions. What we'll do is we'll form kind of appropriate responses for those, and then we'll drop them into the Slack channel as well, so the community can see what the answers to those are.
Great.
Fabulous. Thank you so much, Liam. And thank you for everyone for attending. We will be sending the recording afterwards and all of the key findings as well as a link to the Capsule team if you wanted to go for the health check and or have any one-to-one questions.
Absolutely.
Okay.
And
all right.
if anyone has any questions at any point, at any time, just feel free to drop me a Slack DM and I'll be happy to answer them.
Well, thank you guys. Really appreciate you jumping on.
Thank you.
Speak to you soon.
Cheers.
Thanks.
Thanks.